48 million ounces, demanded for delivery in just 1 month. JP Morgan, Wells Fargo, issuing notices at unprecedented rates. While most investors celebrate record stock market highs, a silent exodus is underway. Physical silver, vanishing from exchange vaults. Peter Schiff warns of a crisis larger than 2008. The dollar posts its worst year in nearly a decade. And the Federal Reserve just made their move. 3 separate market anomalies, all converging at the exact same moment. This isn't coincidence. This is welcome to the boring currency, where we examine what most prefer to ignore. If you've spent decades watching markets, understanding that real wealth isn't built on headlines, but on pattern recognition, then you already know the most critical signals are often the quietest. We'd appreciate it if you'd subscribe, not for entertainment, but because you value analysis over noise. We're curious. Where in the world are you watching this from right now? Drop your location in the comments. Let's see how global this audience truly is. Now, let's examine exactly what's happening in those vaults. On January 27th, 2026, something unusual happened in the world of precious metals, a world most people never see, never think about, never understand, until it's too late. That Tuesday morning, the COMEX exchange issued 79 silver delivery notices. In a single day, JP Morgan alone issued 31 of them. Wells Fargo stopped 52. These weren't just numbers on a screen. These were demands for physical metal, real silver, to be removed from vaults and delivered to buyers. By the end of January, the total stood at 9,680 contracts. Each contract represents 5,000 ounces of silver. The mathematics are simple. 9,680 multiplied by 5,000 equals 40,000 ounces. 48 million ounces of physical silver demanded for delivery in 1 month. To understand why this matters, one must understand what's normal. In a typical January, COMEX might see delivery demands between 1 and 3 million ounces, sometimes less, rarely more. This January delivered roughly 16 times the normal volume, perhaps more. This isn't a statistical anomaly. This is a structural earthquake. Silver at this moment trades above $115 per ounce, a price level that would have seemed impossible just years ago. Yet the price isn't the story. The delivery demand is the story. Because in commodity futures markets, most participants never take delivery. They settle in cash. They close their positions before expiration. They trade paper, not metal. The system depends on this behavior. The entire architecture of futures exchanges is built on the assumption that physical delivery remains the exception, not the rule. When large institutions like JP Morgan and Wells Fargo issue and stop delivery notices at this scale, something fundamental has shifted. These aren't retail investors. These aren't speculators chasing momentum. These are entities that understand counterparty risk, that recognize the difference between a claim on silver and silver itself. Smart money, as market observers call it, doesn't act without reason. When smart money demands physical delivery in quantities that strain the system, when it chooses possession over promises, it signals a loss of confidence in the paper market structure. The question economists and analysts must ask is simple. Why now? Why are sophisticated market participants choosing to drain physical metal from exchange vaults at this particular moment in history? The COMEX system operates on a delicate balance. Registered silver sits in vaults, available for delivery. Eligible silver sits in vaults, but isn't allocated for delivery. When delivery demands surge, registered inventory depletes. The buffer between claims and reality narrows. If this pace continues through February, through March, the mathematical reality becomes unavoidable. There simply isn't enough registered silver to satisfy sustained delivery demand at these levels. Some analysts have begun whispering about what happens when the music stops. When the paper claims exceed the physical reality by margins, the system cannot absorb. History offers uncomfortable precedents. In March 2022, the London Metal Exchange faced a nickel delivery crisis. Trading halted, contracts were canceled, billions in positions were unwound at non-market prices. The official explanation spoke of orderly markets and systemic stability. The reality was simpler. There wasn't enough physical nickel to meet the delivery obligations. Silver isn't nickel. The markets differ in size, liquidity, and strategic importance, but the mathematical principle remains identical. When paper claims exceed physical availability, something must give. Either prices adjust to levels that discourage delivery, or the system itself restructures. The January 2026 delivery data suggests market participants are testing which outcome will materialize. At $150 per ounce, silver has already reached price levels that should, in theory, encourage production and discourage physical hoarding. Yet the delivery notices continue. The vault drainage accelerates. This tells observers something critical about how smart money views the months ahead. They see value in possession that exceeds the cost of delivery, storage, and illiquidity. They see risk in paper claims that warrants the friction of physical conversion. They see something in the broader economic landscape that makes $115 silver worth holding, worth storing, worth removing from the exchange system entirely. Meanwhile, gold trades in parallel parabolic patterns. Stock markets sit at all-time highs. The Federal Reserve prepares for another policy decision, and the US dollar posts its weakest annual performance in 8 years. These aren't isolated events. They're connected, woven together by threads most market participants haven't yet recognized. The vault drainage isn't happening in a vacuum. It's happening in a specific macroeconomic context, one that demands closer examination. Something strange is happening in global markets, something that shouldn't be possible according to traditional economic textbooks. Silver climbs past $150. Gold reaches historic heights. And simultaneously, equity markets hit all-time records. This defies conventional wisdom. Precious metals typically rally when investors fear stock market collapse, when they flee risk assets, when panic replaces confidence. Yet here in early 2026, both are rising together. Fear and greed, dancing in perfect synchronization. This paradox tells a story most economists aren't ready to acknowledge. When assets that normally move in opposite directions suddenly move together, the underlying variable has changed. That variable is trust in the currency itself. The US dollar just completed its worst annual performance in 8 years, not because of a sudden shock, not because of a specific crisis event, but because of something more deliberate, more intentional. President Trump, when asked about the dollar's decline, offered a response that shocked currency analysts worldwide. He described the dollar as like a yo-yo, something he could swing in either direction. He acknowledged his power to reverse the decline, but he didn't speak in favor of strengthening it. This wasn't an accident. This was policy signaling. A weak dollar serves specific economic objectives, objectives that align with the current administration's priorities. Lower dollar values boost U.S. exports. American goods become cheaper for foreign buyers. They reduce trade deficits. The gap between what America sells abroad and what it purchases narrows. They inflate nominal GDP growth. The economy appears larger in dollar terms even if real output remains flat. And most importantly for markets, they inflate asset prices. Stocks, real estate, commodities, all denominated in dollars, all rising as the currency weakens. This isn't economic growth. This is monetary inflation disguised as prosperity. Yet markets celebrate. Indices climb. Wealth appears to multiply. Peter Schiff, the economist known for predicting the 2008 financial crisis, issued a warning that received little mainstream attention. He stated plainly that a financial crisis could be approaching, one potentially larger than what the world experienced in 2008. Most dismissed this as perpetual pessimism, as the predictable stance of a gold advocate. But Schiff's warning wasn't based on sentiment, it was based on structure. In 2008, the crisis emerged from housing debt, from mortgage-backed securities, from leverage concentrated in real estate. The government responded with bailouts, with quantitative easing, with interest rate suppression. These weren't solutions, they were delays. The debt wasn't eliminated, it was transferred, from private balance sheets to public ones, from banks to central banks, from transparent markets to opaque government ledgers. Now, 18 years later, that debt has metastasized. Government debt levels dwarf 2008 figures. Corporate debt has reached historic proportions. Consumer debt continues its upward trajectory. And the only tool available to manage this debt remains the same: currency debasement. Lower interest rates, quantitative easing, direct monetary stimulus, all roads lead to the same destination: more dollars chasing the same goods, more currency units required to represent the same value. On the day the COMEX delivery data showed 48 million ounces demanded, the Federal Reserve held its FOMC meeting. Market participants understood the implications. When central banks cut rates, they signal economic weakness. They acknowledge that the system cannot sustain current interest rate levels, but rate cuts have consequences. They punish savers. They reward debtors. They incentivize asset speculation over productive investment. And they accelerate the flight from currency into tangible assets. This is where the convergence becomes visible. Smart money doesn't flee stocks for gold. It accumulates both. It doesn't choose between paper assets and physical metals. It diversifies into anything that isn't pure currency exposure. Because the real risk isn't stock market collapse. The real risk is currency collapse. When inflation data came in lower than expected, markets rallied. Lower inflation should reduce precious metals demand, should strengthen the dollar, should calm concerns about monetary policy. Instead, silver and gold accelerated their climbs. This disconnect reveals what sophisticated investors understand. Official inflation measurements don't capture real currency debasement. They measure price changes in selected goods, weighted by formulas that shift over time, adjusted for quality improvements that may or may not reflect consumer reality. They don't measure the expansion of the money supply. They don't measure asset price inflation. They don't measure the declining purchasing power of savings held in dollar-denominated accounts. The vault drainage at COMEX represents a vote of no confidence, not in the economy, not in corporate profits, not in technological innovation, but in the currency system itself. When institutions demand physical delivery of 48 million ounces in 1 month, when they choose storage costs and illiquidity over paper claims, they're making a statement about counterparty risk. They're saying the risk of holding a promise has exceeded the cost of holding the metal. This convergence, weak dollar policy, record delivery demand, parabolic precious metals, elevated equity markets, all occurring simultaneously. This isn't coincidence. This is the early stage of a monetary regime transition. The question isn't whether the paper market can sustain this pressure. The question is what happens when it can't. Every financial system operates on faith, faith that a contract will be honored, faith that a promise will be kept, faith that paper represents reality, until one day, it doesn't. The COMEX exchange wasn't designed for what's happening now. It was built for a different era, a different market structure, a different kind of participant. To understand the stress currently building in the system, one must understand how commodity futures exchanges actually function. Most people believe futures markets exist to facilitate physical commodity trading. This is only partially true. The real purpose is price discovery and risk management. Producers hedge future production, consumers hedge future needs, speculators provide liquidity, and crucially, the vast majority never intend to deliver or receive physical metal. Historical data shows that typically less than 3% of silver futures contracts result in physical delivery. 97% settle in cash, positions close before expiration. Profits and losses are calculated in currency, not metal. The system depends on this behavior. COMEX vault capacity isn't designed to handle universal delivery demand. It's designed to handle marginal delivery demand. The mathematics seem safe. If only 3% demand delivery, the exchange needs only enough inventory to satisfy that 3%, plus a buffer for unexpected surges. January 2026 shattered this assumption. When 9,680 contracts demand delivery in a single month, when the delivery rate jumps from 3% toward levels never before sustained, the architectural weakness becomes visible. The exchange holds two categories of silver, registered and eligible. Registered silver sits in approved vaults allocated specifically for delivery against futures contracts. Eligible silver sits in the same vaults but isn't designated for delivery. It belongs to private owners who store it at COMEX facilities. It could become registered, but only if owners choose to make it available. As delivery demands surge, registered inventory depletes. The buffer narrows. Simple projection reveals the problem. If January's pace continues through February, through March, the registered silver available for delivery approaches levels that cannot sustain the demand. What happens then? History offers uncomfortable answers. In March 2022, the London Metal Exchange faced a crisis in nickel trading. A short squeeze developed. Prices spiked to levels that threatened to bankrupt major market participants. The exchange made a decision that shocked the financial world. It halted trading. It canceled trades. It retroactively adjusted prices. Billions in positions were unwound at non-market prices. Contracts that should have been honored were voided. The official explanation emphasized systemic stability, orderly markets, protection of the clearing system. The practical reality was simpler. The exchange chose to protect certain participants at the expense of others. It prioritized institutional survival over contract sanctity. Silver isn't nickel. The markets differ significantly in size and participation, but the principle remains identical. When an exchange faces a choice between honoring all contracts and protecting the system itself, it chooses the system. Every time. The behavior of JP Morgan and Wells Fargo in January's delivery process reveals something critical. JP Morgan issued 31 delivery notices. Wells Fargo stopped 52. These aren't random numbers. These represent institutional positioning on opposite sides of the delivery process. Issuing a notice means a clearing member is delivering metal against short positions. Stopping a notice means a clearing member is taking delivery for long positions. Both actions require physical metal to change hands. When the same institutions that helped create the paper silver market begin demanding physical settlement at scale, when the bullion banks themselves participate in the vault drainage, the signal becomes unmistakable. They know something. They understand the risk that paper contracts may not be honored, or may be honored at prices that don't reflect true market clearing levels. They're converting claims into possession while conversion remains possible. Industrial silver users face a different calculation. Electronics manufacturers, solar panel producers, medical equipment companies all depend on reliable silver supply. If COMEX faces a delivery crisis, If premiums for physical silver diverge dramatically from paper prices, their supply chains face disruption. Some have already begun building strategic inventories, purchasing silver ahead of immediate need, accepting storage costs as insurance against supply disruption. This behavior creates a feedback loop. As more participants demand physical delivery, as industrial users build inventory buffers, as investors convert paper to metal, the pressure on registered COMEX stocks intensifies. Each withdrawal makes the next withdrawal more rational. Each delivery notice increases the probability that future delivery demands cannot be satisfied. This is how paper markets fracture. Not through dramatic collapse, not through single-day panic, but through gradual recognition that claims exceed reality, that promises outnumber the ability to fulfill them. Geographic arbitrage has already begun appearing. Silver prices in Shanghai sometimes trade at premiums to COMEX prices. London market premiums occasionally diverge from New York. These spreads shouldn't persist in functioning markets. Arbitrageurs should eliminate them instantly. The fact that they're appearing, that they're widening, suggests friction in the physical delivery process. It suggests that moving metal between markets isn't as seamless as theory suggests. It suggests that location matters, that possession matters, that jurisdiction matters. The March contract, historically one of the largest delivery months for silver, approaches. Market observers watch with unusual attention. Will delivery demands continue at January's pace? Will registered inventory prove sufficient? Will the exchange implement position limits, force majeure clauses, or contract modifications? These aren't theoretical questions. These are practical considerations that sophisticated market participants are actively modeling. Because if the paper market fractures, if COMEX cannot satisfy delivery demands, if the exchange chooses to modify contracts rather than honor them, the implications extend far beyond silver. Every commodity futures market operates on the same assumptions. Crude oil, natural gas, copper, agricultural products all depend on the faith that paper represents reality. If that faith breaks in silver, the contagion potential is enormous. Smart money isn't waiting to find out. They're acting now, while conversion remains possible, while vaults still hold inventory, while the system still functions. The question facing everyone else is simple. How long does that window remain open? Markets don't announce their breaking points in advance. They whisper, then crack. The January 2026 delivery data isn't a conclusion. It's a warning shot. And warnings exist for those willing to listen. The question facing institutions, corporations, and individuals isn't whether the current trajectory is sustainable. The mathematics already answered that question. The real question is, what should be done about it? Strategic response begins with scenario assessment, not prediction, assessment, because in complex systems, certainty is impossible, but preparation is mandatory. 3 scenarios emerge from current conditions. The base case assumes continued elevated delivery demand through Q1 2026. Registered COMEX inventory gradually depletes. Physical premiums expand, but the system survives through higher prices and reduced paper speculation. In this scenario, silver continues climbing, 120, 130, perhaps higher, until price alone discourages physical conversion. The market clears, the exchange survives, paper and physical eventually realign. The stress case envisions delivery default. COMEX cannot satisfy March delivery demands. The exchange invokes force majeure clauses. Contracts are modified. Cash settlements are imposed at prices below market. Legal challenges follow. Trust in futures markets suffers lasting damage. In this scenario, physical silver premiums explode. The disconnect between paper prices and physical reality becomes permanent. 2 separate markets emerge, one for claims, one for metal. The tail risk imagines broader contagion. The silver fracture spreads to other commodity markets. Confidence in futures exchanges collapses. Physical commodity hoarding accelerates across multiple sectors. Supply chains face disruption. Monetary authorities respond with interventions that accelerate currency debasement. In this scenario, the monetary regime itself comes into question. Each scenario demands different responses. For institutional capital managers, the priority becomes exposure verification. How much precious metals exposure exists in portfolios? Is that exposure through physical holdings, ETFs, futures contracts, or mining equities? Each carries different counterparty risk profiles. Physical holdings and allocated storage face minimal counterparty risk, but require verification that allocation is real, not merely claimed. ETFs hold metal on behalf of shareholders, but legal structures vary. Some allow redemption in physical, others only in cash. The difference matters critically if premiums diverge. Futures contracts are pure counterparty exposure. If COMEX modifies contracts, paper losses materialize regardless of physical market reality. Mining equities offer indirect exposure, but introduce operational risk, political risk, and equity market correlation. Sophisticated institutions are reviewing these distinctions now, not in panic, In methodical reassessment, corporate treasury departments face different calculations. Industrial silver users must secure supply chains. A solar panel manufacturer cannot afford production disruption because silver becomes unavailable at any price. Strategic inventory building becomes rational, even at 115 per ounce, even with carrying costs, even with balance sheet impact, because the alternative, production halts, contract defaults, revenue loss, is catastrophically worse. Some corporations have already begun this transition. They're purchasing silver ahead of immediate need. 3 months, 6 months, 12 months of inventory. This isn't speculation. This is risk management, and it accelerates the very dynamic they're protecting against. For individuals managing personal wealth, the framework simplifies but doesn't become easier. Physical possession carries costs, storage, security, insurance, liquidity constraints, but paper claims carry risks that January's data has made visible. The calculus depends on individual circumstances, risk tolerance, time horizon, liquidity needs, but the principle remains constant. Diversification across claim types reduces concentration risk, some physical, some paper, some in domestic jurisdiction, some offshore, some in personal possession, some in allocated vault storage. No single point of failure. Warning indicators now deserve systematic monitoring. Weekly COMEX inventory reports reveal registered silver trends. Are levels stabilizing, declining, accelerating downward? Delivery notice patterns in upcoming months provide advance signals. March is historically significant. May and July follow. If delivery demands remain elevated through multiple contract months, the base case shifts toward stress case. Spread behavior between spot and futures prices reveals market stress. Backwardation, when spot prices exceed futures prices, indicates supply tightness. Geographic spreads between COMEX, London, and Shanghai reveal arbitrage friction. Widening spreads suggest physical delivery constraints. Central bank gold purchase data offers a parallel indicator. If monetary authorities accelerate precious metals accumulation, their actions reveal their assessment of currency stability. Credit default swap movements in the bullion bank sector provide early warning of institutional stress. Rising default insurance costs suggest market participants pricing in counterparty risk. These indicators won't predict the future with certainty, but they'll reveal whether current trends are accelerating or moderating. Risk mitigation follows a hierarchy. Immediate actions focus on exposure verification and counterparty assessment. What exactly is owned? Where is it held? Who are the counterparties? What happens if they fail to deliver? Medium-term adjustments involve allocation rebalancing, reducing exposure to high counterparty risk vehicles, increasing exposure to low counterparty risk alternatives, accepting friction costs as insurance premiums. Long-term positioning requires structural portfolio adaptation, not to a specific price prediction, not to a particular crisis scenario, but to a broader reality. Monetary systems are transitioning. The post-World War II dollar standard, the petrodollar recycling mechanism, the treasury market as global risk-free asset, the Federal Reserve as ultimate backstop. These structures aren't collapsing overnight. They're evolving, slowly, then suddenly. The vault drainage at COMEX is a symptom, not a cause. The underlying driver is loss of faith in purely paper wealth. Smart money doesn't move on headlines. It moves on structure. It recognizes when mathematical realities exceed system capacity. It acts before consensus, before validation, before certainty, because by the time certainty arrives, the opportunity for strategic positioning has passed. History shows that major financial restructurings are always preceded by similar patterns. Divergence between paper claims and physical reality. Acceleration of physical demand by sophisticated actors. Official reassurances that everything is stable, until suddenly it isn't. The 1971 closure of the gold window, the 2008 financial crisis, the 2022 nickel squeeze. Different specifics, same structure. January 2026 may be remembered as another data point in this pattern, or it may be remembered as the moment the pattern broke entirely. Either way, preparation beats prediction. Smart money is emptying COMEX vaults now, not because they know what happens next, but because they understand what happens when paper exceeds reality, and they choose to be on the side of reality before the choice is no longer available.